Hello everyone, this is Professor Eskew, and this is video 3 for Chapter 1, Introduction to Financial Statements. In this video, we're going to talk to you about an annual report and all of the components and supplements that go into an annual report. Most companies, especially all corporations that are publicly traded, must generate or create an annual report. An annual report is a compilation of several different things. They include the financial statements, and if you remember from video 2, the 4 financial statements are the income statement, statement of retained earnings, balance sheet, and statement of cash flows. All 4 of those are included in the annual report. Additionally, there is a management discussion and analysis. What this section entails is the management talks about the financial results of the organization as displayed through those 4 financial results. So they're talking about specific items such as debt structure, in revenues, what segment or segments created the revenues, what expenses are there, how they foresee things changing in the future, and how things may remain the same. There's also notes to the financial statement. Notes to the financial statements will talk to us about specific line items. For example, if it's a debt item, it may tell us when the debt matures, what the debt consists of, who the debt is with, what is the interest rate, what is the monthly payment, what is the annual payment, and what are the annual payments going forward, sometimes out as far as the next 5 years. Then the final thing is the auditor's report. And the auditor's report is the report that the external auditors, and external auditors are accounting auditing firms that actually come in and audit the operations and the financial statements of the company, and then makes an assessment of the quality of the financial statements. So let's look a little bit closer into these items. The management discussion and analysis, or as it's known in industry, MD&A, covers again all of the analysis of the operations. It talks about the company's ability to service its debt or pay its debt, its ability to maintain operations through cash flow, if there's any consideration to expanding operations, increasing perhaps product lines, and then it discusses the overall day-to-day operations and what that looks like. Management should also talk about the industry. It should talk about those things that are going well in the industry, those items that may be unfavorable, that are not necessarily caused by the company, but could be caused by external events such as the economy, perhaps new legislation that has been enacted that could impact it. It could be new technology. It could be new competition in the marketplace. Anything that could potentially affect the corporation positively or negatively should be discussed. It could also talk about things that are called significant events. Significant events could be things like a company merging with another company. It could be a lawsuit that's brought against the company. It could be legislation, again, that could have a significant impact on earnings. And all of those items should be discussed, and management is charged with thinking through and trying to forecast what possible outcomes could happen and what are the impacts on the corporation if those outcomes occur. In your textbook, we look at Tootsie Roll Industries. And here's a brief excerpt from the management discussion. Here it says this: the company has a relatively straightforward financial structure and has historically maintained a conservative financial position. What this says is, hey, our financial statements are basically the norm. We don't have any unique items that you should be aware of. It's the basic assets, liabilities, owner's equity, income, and expenses. And we also are conservative, which means that we are not actively taking risks in any certain areas. Further, it says, except for the immaterial amount of operating leases, the company has no special financing arrangements or off-balance sheet special purpose entities. What it's saying here is, hey, we have normal debt, and that debt is used for our operations. We don't have any special financing. In other words, we're not doing any events that would cause us to have financing or debt that would be for a offshoot of what we normally do in our day-to-day business. And we don't have any off-balance sheet entities, which means we don't have any companies or companies that are related to us but separate from us that holding debt for special or specific purposes. It further says cash flows from operations plus maturities of short-term investments are expected to be adequate to meet the company's overall financing needs, including capital expenditures in 2012. What this sentence says is, we generate enough cash internally from our operations that we can make sure that we continue to operate using those without any additional borrowings. And we can also take that internal cash and finance any capital expenditures such as property, plant, and equipment, and it should be covered by the normal cash flow of the company. Notes to the financial statement simply serve to clarify the financial statements themselves. In other words, if you see a specific line item on a financial statement and you have a question, the note section will typically give you a thorough explanation of what's happening with that line item. It will also talk to you about uncertainties and contingencies. If you see below where it says revenue recognition, revenue net of applicable provisions for discounts, returns, allowances, and certain advertising and promotional costs is recognized when the products are delivered to the customers based on the customer's purchase order and collectability is reasonably assured. What this statement is simply saying is we don't count our sales when we ship our Tootsie Rolls. We only recognize revenue when we are sure that the delivery has occurred and we are reasonably assured that the company who received our product can pay us back. The Auditors Report. Again, I said earlier that an auditor is an external auditor, so they're outside of the firm. They're typically an accounting firm, and they will look at the operations. They will look at the financial statements. They will make sure that their ethical conducts are being occurred in the company, and that the company is also following generally accepted accounting principles. We call that GAAP. What they will speak to is a statement that says the representation by the organization is fair. So let's look at what the auditors say about Tootsie Rolls. First, they address the board of directors and the shareholders, so everyone who's interested in Tootsie Rolls ownership or management are addressed. It says this: In our opinion, the accompanying consolidated statements of financial position and related consolidated statements of earnings, comprehensive earnings, retained earnings, and all cash flow are presented fairly in all material respects. The financial position of Tootsie Roll Industries and its subsidiaries at December 31st, 2011 and December 31st, 2010, and the results of their operations and cash flows for each of the 3 years periods ended in December 31st, 2011 are in conformity with generally accounting principles generally accepted in the United States. So what they've said here is all of the financial statements have been presented in a manner that's according to GAAP, and that they are fairly presented, and there is nothing hidden. There are no errors, whether they were purposeful or inadvertent. Everything checks out, and they issue an opinion that says in all material respects, so in all areas where it makes a significant difference, effectual internal controls over financial reporting as of December 31st, 2011, based on criteria established in the Internal Control and Integrated Framework issued by the Committee of Sponsoring Organizations of Treadway Commission. So they're saying that this auditor's report is fine, that you as a user can rely on the information given. So in this video, we've given you all of the components of an financial annual statement by a corporation, and discussed with you all of the supplemental information that you will find in that annual report. This concludes the 3-video series of Chapter 1. Go back and review all of the objectives for the chapter, and we hope you had a good time with this video. We'll see you in Chapter 2.